September 6, 1945. Somewhere in Hong Kong, a man holds a stack of banknotes so thick it fills both hands. He walks to the market. He needs rice. He needs medicine. He has worked for 4 years, saved everything he earned under Japanese occupation, done everything right. The cashier looks at the notes, shakes her head, and says nothing. The Japanese Ministry of Finance has just declared all military yen void. Overnight, without warning, every note he holds, every hour of labor they represented, is now wallpaper. Useless. Gone. He didn't lose his money in a market crash. He didn't make a bad investment. He held cash. And cash, in 1.9 billion yen worth of notes, was declared worthless by government decree in a single sentence on a single morning. That is not a wartime anomaly. That is the oldest story in monetary history, told again and again and again, and yet somehow, remarkably, most people still haven't heard it. This video is the forensic file on that story. I went through World War II market data, the currency records of defeated and victorious nations, the testimony of investors who survived the worst economic catastrophe of the 20th century, and the post-war asset analysis conducted by some of the most rigorous financial historians alive. What I found is not theory. It is documented, verified, replicable, and it tells you exactly which assets survived when entire monetary systems were erased, and exactly which ones died with the currencies that printed. Before we get into the assets, you need to understand the mechanism, because this is not about war. War is just the accelerant. The underlying pattern was already in motion long before the first shot was fired. Architecture of monetary collapse. Every major currency failure in modern history follows the same 5-stage architecture. Stage 1. The government spends more than it collects in taxes. Stage 2. It bridges the gap by printing new money. Stage 3. The currency begins lows. ING purchasing power as more units chase the same goods. Stage 4. Citizens recognize what's happening and flee into hard assets, foreign currency, or barter. Stage 5. The currency collapses entirely, either through hyperinflation, government decree, or defeat in war. You've seen this before in peacetime. Weimar Germany, 1921 to 1923. Venezuela from 2016 onward. Zimbabwe in 2008. Lebanon after 2019. But World War II was a laboratory for this process on a global scale, running simultaneously across dozens of nations. The speed of collapse was faster, the scale was larger, and the forensic data it produced is cleaner, because the causes were so catastrophic and undeniable. Germany's money supply had expanded 5-fold between 1939 and 1945. Japan's wholesale prices increased 13-fold between 1946 and 1949 alone. The Reichsmark, which had been Germany's currency since 1924, was so degraded by 1948 the Allied powers replaced it virtually overnight with the Deutsche Mark, at a conversion rate that wiped out 90% of the nominal value of every savings account and bond in the country. Not 10%, not 50%, 90%. German bondholders lost over 92% of their wealth in real terms after the war. People who had done the responsible thing, saved in government bonds, kept cash in the bank, watched their entire financial lives erased by a currency reform they had no vote in and no warning of. The yen tells the same story with different numbers. When Allied occupation forces entered Japan in August 1945, the official exchange rate was set at 15 yen per dollar. Within 2 years, it had deteriorated to 600 yen per dollar. By 1949, when a stable peg was finally established, the rate was 360 yen per dollar. A Japanese citizen who had saved money in yen at the start of the war and held it faithfully to 1949 had watched that money lose approximately 97% of its dollar-equivalent purchasing power. Wartime inflation in Japan didn't just punish investors. It destroyed the entire savings class. This is the environment in which we now ask the question that actually matters. In the ruins of the most destructive war in human history, with currencies dying, governments dissolving, and entire financial systems being rewritten from scratch, what held value and what didn't? Let me show you. Asset 1. Gold, the monetary constant. Gold did not survive World War II because it performed brilliantly. It survived because it was the one thing that didn't need to perform anything at all. Understand the distinction. In 1939, gold in the United States was fixed at $35 per ounce under the Bretton Woods framework, which would formalize after the war. That price hadn't changed since Franklin Roosevelt repriced it from $20.67 in 1934. It would not change until 1971. For most Western investors holding gold during the war, the nominal price didn't move at all. And yet, gold preserved wealth in a way that no other financial asset matched, not because its price rose, but because everything around it fell. In Germany, a person who converted their savings into physical gold in 1939 emerged in 1948 with their purchasing power essentially intact. Their neighbors who held Reichsmarks emerged with approximately 10 cents on every dollar they had saved. In Japan, the same dynamic played out in yen. The currency was decimated. Gold maintained its international purchasing power because gold, unlike currency, cannot be printed, cannot be voided by government decree, and requires no government's promise to remain valuable. Barton Biggs, the legendary Morgan Stanley strategist who spent years forensically analyzing World War II-era financial records, documented precisely this phenomenon in his foundational work on wartime wealth preservation. His research into occupied Europe confirmed the pattern. Those who held physical gold, particularly if it was portable and discreet, preserved both wealth and, in many cases, their lives. Gold could be exchanged for food, for passage, for bribes, for the kind of immediate transactional value that no paper asset could provide when governments had collapsed and banks had closed. There is a critical nuance, however, and history demands we state it plainly. During World War I, many countries began abandoning the gold standard entirely. By the 1930s, most had fully severed the link between their currencies and gold. By the end of World War II, the United States controlled 75% of the world's monetary gold, a staggering concentration that happened precisely because frightened European nations and individuals shipped their gold to American vaults for safekeeping as war engulfed the continent. Gold wasn't just an investment. It was the last form of portable, universally recognized value when every other form of value had been made conditional on the survival of a particular government. The pattern holds in every century, in every collapse. It held in Weimar. It held across occupied Europe. It held in Japan. And if you're looking for why central banks, including those of Russia, China, India, and Turkey, have dramatically accelerated their gold purchases in the past 5 years, you are looking at institutional memory of exactly this mechanism. Asset 2. Productive land, the asset that fed people. This one requires a different kind of analysis, because land did not survive the war in the same clean, numerical way that gold did. Land survived in ways that were ugly, complicated, and deeply human. Barton Biggs, after reviewing the testimony and records of hundreds of World War II-era wealth preservation cases, reached a conclusion that surprised even him. The single most reliable vehicle for surviving catastrophic economic collapse in both Europe and Asia during the war was not gold, not stocks, not foreign currency. It was what he called a homely farm, productive agricultural land, far from major population centers, modest enough not to attract attention, capable of producing food. The reasoning is brutal in its simplicity. When currencies collapse, when supply chains break down, when banks close and markets freeze, one thing retains immediate, incontrovertible value: the ability to feed yourself and your family. In occupied France, in wartime Germany, in rural Japan, those who owned productive farmland had something that no amount of paper money could buy: food security. Farmers were often the last people to starve. In many cases, they were the economic anchors of their communities, accepting gold, jewelry, and goods in exchange for produce when cash had become worthless. This is not historical romance. It is documented economic fact. In Weimar Germany, farmers refused to sell produce for paper currency. Workers marched into the countryside to barter goods for food. The farmers who owned productive land operated in the most valuable economy of the era, the barter economy, because they controlled the one commodity everyone needed regardless of what was printed on a banknote. Agricultural land in the United States demonstrated the same resilience through a different mechanism. During World War II, American farmland values remained stable to rising because the country's food production machine was running at full capacity to feed both domestic consumers and Allied forces across 2 theaters of war. In England, roughly 30% of homes were destroyed or damaged during the war. Urban real estate in Germany and Japan was catastrophically impacted, bombed, seized, redistributed. But productive rural farmland, particularly in countries not directly invaded, maintained its fundamental value because it maintained its fundamental function. The critical distinction that Biggs makes repeatedly is this: real estate as a concept is not a uniform asset class in wartime. A townhouse in Dresden is not the same asset as farmland in Bavaria. A commercial building in Tokyo is not the same asset as rice paddies an hour outside the city. Urban real estate in the line of fire was destroyed, seized, or made worthless by the collapse of the surrounding economy. Rural productive land, particularly farmland, held its value because it held its function. You cannot bomb away the fertility of soil. You cannot void by government decree the fact that food grows from the ground. Biggs's recommended allocation for catastrophic event planning was approximately 5% of net worth in productive farmland, not as speculation, but as the kind of bedrock, food-producing insurance that the worst scenarios in human history have repeatedly validated. Asset 3. Stocks. The most counterintuitive survivor. Here is where the data becomes genuinely surprising. And here is where the distinction between victorious and defeated nations is not merely interesting. It is everything. In the United States, the Dow Jones Industrial Average rose 50% from 1939 to 1945, 7% annualized, through the worst war in human history. When Hitler invaded Poland in September 1939, the Dow rose 10% in the following session. After Pearl Harbor in December 1941, stocks initially fell, but only 2.9%, and those losses were fully erased within a month. The market hit its wartime bottom in late April 1942. From that bottom through VJ Day, the cumulative return was 87%. The annualized return over the full 4-year period from Pearl Harbor to December 1945 was 13.58%. This is not noise. This is not luck. This reflects something profound about what stocks actually are. A stock is not a piece of paper. A stock is fractional ownership in a productive enterprise, company with factories, employees, patents, supply chains, revenue, and the capacity to adapt to new conditions. And in wartime, particularly for nations on the winning side, productive enterprises don't just survive. They thrive. Defense manufacturing, steel, oil, chemicals, logistics. The entire industrial backbone of a wartime economy was running at maximum capacity. Companies were generating cash. Dividends were being paid. Shareholders were being rewarded. Barton Biggs documented something even more remarkable. The stock markets themselves appeared to have foreseen the war's major turning points before almost any human analyst. The British stock market bottomed in late June 1940, before the Battle of Britain, before the darkest days of the Blitz, before any rational analyst would have said the worst was over. The Dow bottomed in late April 1942, 2 months before the Battle of Midway, which was the decisive turning point of the Pacific War. German stocks peaked almost exactly at the moment the Wehrmacht's advanced patrols first sighted the spires of Moscow, the high-water mark of German expansion, and then began a slow, inexorable decline that tracked the war's outcome with eerie precision. Markets, in short, were processing survival probability in real time. And they got it right. But the analysis must be honest about where stocks failed catastrophically. In Germany, the Nazi government froze stock prices by decree in January 1943 to prevent further decline. Trading essentially ceased because no rational seller would accept a price the government had artificially set. When the currency reform of June 1948 arrived, German shareholders lost 90% of their nominal capital value in the conversion to Deutsche Marks. They were better off than bondholders, who lost everything, but the loss was still severe. In Japan, the inflation from 1946 to 1949 was so severe that even equity holders saw their real returns consumed by prices increasing 13-fold. The conclusion is precise and important. Stocks in victorious, intact economies with functioning markets, primarily the United States and, to a lesser extent, Britain, performed extraordinarily well during World War II. Stocks in economies that lost the war or were occupied and destroyed suffered catastrophic losses that no equity premium could compensate for. Geography was destiny, which brings us to the single most underappreciated insight from the entire World War II financial forensic record: what failed and why it failed completely. Let us be precise about what was destroyed. Cash. Every form of paper currency in defeated or occupied nations was either inflated to near worthlessness, replaced by occupation money, or voided by government decree. The Japanese military yen was declared void on September 6, 1945, gone overnight. The Reichsmark lost 90% of its value in a single currency reform in 1948. The currencies of every nation occupied by Germany, France, Belgium, Netherlands, Poland, Norway were controlled, manipulated, and in many cases replaced entirely. The currency in your wallet is not your wealth. It is a promise made by a government that may or may not exist tomorrow. Government bonds. In every nation that lost the war, government bondholders were destroyed. German bondholders lost over 92% in real terms after World War I. They lost everything again after World War II. Japanese government bondholders watched their holdings consumed by inflation. The logic is stark. A government bond is a promise by the government to repay you in the government's currency. If the government loses a war and the currency collapses, the promise means nothing. You own a liability of an entity that no longer exists, payable in a unit of exchange that no longer functions. Savings accounts. Same mechanism, same outcome. The bank's promise to return your money is denominated in currency. Collapse the currency, void the bank. In Weimar Germany, middle-class families who had saved their entire lives in bank accounts watched those accounts become worth less than the paper they were denominated on. Literally, by late 1923, the paper the notes were printed on had more commodity value than the notes themselves. People burned banknotes for heat because the cost of firewood, denominated in marks, exceeded the calorific value of the notes themselves. This is not exaggeration. This is documented economic history, pattern no one wants to acknowledge. Here is the thing about historical financial forensics that makes people deeply uncomfortable. The pattern doesn't require a world war to manifest. It only requires the 5-stage sequence. Government spends beyond its means, prints money to cover the gap, currency loses purchasing power, population flees to alternatives, collapse follows. By the end of World War II, the dollar was the only currency still backed directly by gold. By 1971, Nixon severed even that connection. Since 1971, every major currency in the world is a fiat currency, backed by nothing except the political stability and fiscal discipline of the issuing government. In the 53 years since, we have seen that fiscal discipline consistently eroded across most major economies. Global debt-to-GDP ratios are at historic highs. Central bank balance sheets expanded at unprecedented rates during COVID. Money supply growth in 2020 and 2021 exceeded anything seen outside wartime. The World War II forensic record is not a history lesson. It is a financial stress test, the largest, most complete, and most brutal wealth preservation experiment in human history. The results are clear. Gold survived because it couldn't be printed. Land survived because it couldn't be voided. Stocks survived because real companies, with real assets and real revenue, continued to function even as currencies failed around them. Cash, bonds, and savings accounts in defeated or unstable nations were destroyed entirely, not because the people WHO held them were foolish, but because the institutions backing those assets failed. The people who preserved wealth across the worst economic catastrophe of the 20th century were not geniuses. They held things that existed independent of government promises. They held things that retained function when trust collapsed. That lesson cost tens of millions of lives to teach. It would be a profound waste not to learn it.